Hey everybody, in this video we're talking about the loanable funds market. We're going to talk about everything you need to know as far as the loanable funds market is concerned. Let's start with this, guys. What's happening in the loanable funds market? What's happening there is borrowing and savings. That's technically the most precise way to talk about what's happening in the loanable funds market. Borrowers and savers are being brought together, okay? Now, here at Econ Busters, we'll occasionally say borrowing and lending, okay? But that's technically not the best way to refer to it. Let me explain why. The supplier of loanable funds is households, okay? So households are the suppliers of loanable funds, okay? They save more than they borrow, and this excess in savings, known as net savings, is that supply of loanable funds. So let's go ahead and draw that. Here they are supplying their loanable funds. What is that? That is savings, all right? Now what they're doing is they are supplying those loanable funds to financial intermediaries, market makers. Think of banks. It could be other things besides banks, but just think of banks. That's the easiest thing. And what banks do is they then go do all the credit checks, right? They go figure out who to lend this to. The actual institutions that lend are the banks. And so what that means is they're doing the credit checks, who's the most credit worthy, and then they lend the money. But we're not focused so much on that act of lending. We're focused on the source of the funds. The source of the funds is household savings. That's the key thing. Yes, there's a financial intermediary. They're the ones that are doing the credit checks, finding out who's credit worthy, and then they're lending. And so the savings is being funneled to borrowers, okay, via the financial intermediaries. So the best way, again, to talk about it is savings and borrowing, and they're being brought together here by financial intermediaries. So technically we're not supposed to say lending, because the actual act of lending is not the household, it's the intermediary. But that's not what we're focused on. We're focused on the source. Now, since I have already the source of savings, I want to talk about who's doing the borrowing, and who's doing the borrowing is businesses and governments, okay? Now, I got to put a little asterisk here, okay, because different classes handle this differently. We're going to talk about here at Econ Busters how we handle it, and then we'll talk about how other classrooms also handle it sometime during the video. But there we go. That's kind of a picture of what's going on. The next thing that I want you to understand about this market is it is a place where those who have excess funds are coming together with those that are deficient in funds. Now, for just a moment, let me step back, okay? There are just three natural markets in a domestic economy. And that's what you're doing in macroeconomics, is you're studying a single economy. We call that economy the domestic economy. And inside of the domestic economy are three natural markets, three general types of markets. And these should make total sense to you. Number one is a product market, where goods and services are sold, of course, right? Goods and services are the things to satisfy our needs and basically to sustain our lives and enrich our lives, okay? So we definitely need goods and services. The next thing is we need resources, right? Resources to make those goods and services. So we have a resource market. So goods and services, product market, resources, resource market. That should be like, of course. And then there's just one other natural market. And that other natural market is a place where those with excess funds and those that are deficient in funds come together. Now, those with excess funds, okay, excess income, you could say, what does that mean? It means that they are buying all the goods and services that they absolutely need, and they are actually willing to forego buying more goods and services for the right price. And what would that price be? The real interest rate, right? They'd be willing to forego more goods and services today for the right price, for the right real interest rate. Those who are deficient in funds, or you could say deficient in income, they want more goods and services, okay, than their funds or income, generally speaking, okay? What they are willing to do is they'd be willing to borrow and pay interest at the right price, i.e. the right real interest rate. They're deficient in funds. And so we have a market that are bringing these two groups together, and that is a very natural thing. In fact, for individuals, okay, we might find ourselves here at some points in our lives and here at some points in our lives. Okay, next. In a macroeconomy or a macroeconomics class, there are 5 macro aggregate actors, okay? Who are those 5 macro aggregate actors? They are households, okay, businesses and governments, the rest of the world, and central banks. I know, kind of a weird place to put them. I'm going to talk about each one of these. First, let me talk about households. As we said, they have excess funds in the aggregate. You aggregate all households together in an economy, and the savings is greater than the borrowing. That excess in savings, that net savings, is again our supply of loanable funds. Let me go ahead and put supply of loanable funds. Those are our suppliers of loanable funds. And I'm just going to put domestic households, and you'll understand why in just a little bit. Next, deficient in funds. Businesses, they often need funds for all kinds of reasons: to start their business, to scale their business, to maintain their business, to update their technology and their processes. They are in need of funds. And the government is often deficient in funds. Here in the United States, yes, they are deficient in funds. They're running very big deficits, okay? So the governments run deficits. They need funds also. So they're going to go and borrow. They are our demanders of loanable funds. Again, little asterisk here because some classes do handle that a little bit differently. I'll talk about that later. Next, rest of the world. Here's how we're going to handle the rest of the world. Okay, let me erase that because I'm going to kind of change that just ever so slightly. We have households domestic and we have households foreign. Okay, so households in domestic country, households in foreign countries. Now, households domestically, what do? They take their savings to domestic loanable funds markets, and they take their savings to foreign loanable funds markets. Hopefully that makes sense. And just to let you know, we're going to do, of course, a loanable funds market here in a little bit. And you could just think of putting the word domestic right there because that's what's happening, right? We're just looking at the loanable funds market in a single country, that country being the domestic country. All right, so domestic households, they take their savings to their domestic loanable funds market and abroad. This right here, we have a name for that. Let's go ahead and make it kind of stand out, hopefully. That is called a capital outflow, okay? And by the way, remember, what are we doing? We're trying to account for that rest of the world that I erased, right? So there we go. Capital outflow is savings heading to the rest of the world. Now, foreign households, they take their savings to the domestic loanable funds market that we're examining in any problem, okay? So I'm not saying their own, I'm saying the one that we're examining, okay? Or foreign households take their loanable funds to foreign loanable funds market, which could be their own loanable funds market. Again, everything's from the domestic economy that we're examining. This is a little bit confusing. Let me just make sure I'm clear that this and this are the same thing. It's the country we're examining. So here are foreign households taking it to the loanable funds market of the country we are examining. Now, I'm going to erase one thing because when foreign households do things in foreign loanable funds markets, we're not very concerned about that. So I'm going to erase that. That doesn't make our graph at all. But when foreign households take it to the loanable funds market that we're talking about, that is called a capital inflow. And now we have accounted for the rest of the world. Next, central banks. I'm going to erase that one. When it comes to central banks doing things, okay, there's generally two models we're going to go to: the money market or the market for bank reserves. Okay, we're either going to go one or the other of those models. When central banks do things, we generally don't go here. Okay, so again, here's where borrowing and saving is taking place. So we're generally not going to associate central bank action in this graph. When central banks do stuff, and of course we're in the United States, so I can say Fed. When the Fed does something, go to the money market or go to the market for bank reserves, whichever one is best for whatever they're doing, okay, or whatever framework they have. So there we go. We've taken care of a lot now, okay? We've got our 4 macro aggregate actors that we associate with this graph, okay? We've got the rest of the world. The rest of the world's accounted for with these capital inflows and outflows. So we've got the domestic actors interacting with the rest of the world and foreign actors acting with the domestic economy. Then we got businesses and government, and we've talked about why they want money or demand loanable funds. So they're borrowing, okay, and we've got the savings coming from households. One last thing on the savings coming from households. Remember, it's households that earn the income from the 4 factors of production: wages, rent, interest, and profit. So it makes sense that they would be the source of loanable funds since they are the receivers of income for the 4 factors of production. All right, with all that said, I think we are now ready to draw this graph, all right? So first thing, we've talked about it already, that the price of loanable funds is the real interest rate. It's the real interest rate. As I like to say, The savers, what the active saving is it is foregoing goods and services today to be able to buy goods and services in the future. And when we say goods and services, we should be thinking real, okay? Here at Econ Busters, we have a thing that we say, which is when we say real, say goods and services. Say goods and services, say real. When we say nominal, say dollars. When we say dollars, say nominal. So when we talk about the loanable funds market, the decisions about savings are based on the real interest rate, and the decision about borrowing is based on the real interest rate. Ultimately, what borrowers care about is how much real value they're going to have to provide to the world to get out of debt, okay? So they also make their decisions based on the real interest rate. Okay, next thing to go with. Let's get the curve. Oh, forgot about this. Hey, if it says market, you put quantity of, and then you just put quantity of what? The thing in the title. So there it is, quantity of loanable funds. Loanable funds, that's what we're measuring here. The quantity of loanable funds. What are we measuring here? Borrowing and savings. That's what we're measuring there. Okay, now we're ready to draw the lines, okay? First of all, let's do the supply of loanable funds. Comes from households. This is the benefit of supplying loanable funds. That's what you earn. So as that benefit goes up, we will supply more. So we get that upward sloping line, supply of loanable funds. Remember, who we are associating with the supply of loanable funds is households. Households domestic and households foreign. Oops, sorry, put a P instead of an F, households foreign. Okay, and what we like to say here at Econ Busters is those are private sector actors, and since they're private sector actors, they're definitely sensitive to the interest rate. When you're not sensitive to this variable, you would see a vertical line, but they're private sector actors, they're sensitive, so we're either going to see it upward sloping or downward sloping, and again, since the real interest rate is the benefit of saving, it's going to be upward sloping. Next, we're going to handle governments, even though they're not the number one demanders of loanable funds. The number one demanders of loanable funds are businesses, and it's important to say that. But we're going to handle governments first, and the reason is it kind of gives us a base. And what do I mean by that? Government's demand for loanable funds, I'm going to do it as a dashed line because I'm going to erase it. It looks like that. Remember, they're a public sector actor. They're borrowing money not based on the real interest rate. They're borrowing money based on their deficit. So important to understand. They're borrowing money based on their deficit. What is that distance? What's that distance? What's that distance? First of all, it's the same distance. It's whatever their deficit is. Again, they are insensitive to the real interest rate. They're a public sector actor. They're borrowing not based on this, but based on their deficit. Now, on that, we are going to add businesses' demand for loanable funds, also known as the investment demand curve, okay? So if you study the investment demand curve in your class, we're adding that investment demand curve onto this, which is businesses' demand for loanable funds. Now, I could kind of do what I'm about to do anywhere, but I'm just going to kind of pick it right there and go down. So demand for loanable funds. Now, I'm going to get rid of this portion of the curve. I don't need that. And then I'm going to make this portion of the curve vertical. Now, you do not need to do that. Very few classes are going to do that. Very few textbooks will you ever see this, okay? You don't have to put that little vertical if you don't, but it does exist, guys. That's the deficit. The government will borrow money based on their deficit regardless of how high that real interest rate gets, okay? But you don't have to draw it. We're always going to intersect where the demand curve is downward sloping and the supply curve is upward sloping. And just let me finish it off. The downward sloping portion of the demand for loanable funds is coming from businesses, which is a private sector actor, which is of course sensitive to the real interest rate. The real interest rate is the cost of loanable funds. Remember, businesses are demanding them. They're demanding them to do projects, and they're only going to demand loanable funds if the expected real rate of return of a project is greater than the real interest rate. When the real interest rate goes up, they're going to borrow less. Real interest rate goes down, they're going to borrow more. Downward sloping line, and just remember that's businesses and the government. Okay, now let's handle some questions that we might get. The first question we might get is we might just get, hey, households, and when they just say households, they're talking about the domestic households, want to save more. What's going to happen? Well, that one's pretty straightforward. Households want to save more, supply of loanable funds, shift it to the right, and guess what? That real interest rate is going to go down, right? Just shift that supply to the right. If it says households start saving less, we can handle that. If households, again, when they say households, they're generally talking about like domestic households. Doesn't matter. Okay, I guess they could be talking about domestic and foreign households. Anyhow, either way, we're going to shift this to the left, okay? The next thing we're going to hear is maybe a statement like an increase in capital outflows. What's an increase in capital outflows? It's when domestic savers want to go abroad, right? And not go to their own domestic loanable funds market. So if we get capital outflows, again, domestic savers wanting to go abroad, not wanting to go to their own domestic loanable funds market, that's what we're going to do. We're going to shift that curve to the left. There's going to be less supply of loanable funds to our domestic loanable funds market. Remember, we're always examining some country's loanable funds market. So domestic goes right there. Okay, capital inflows. Let's say, hey, foreign households want to come in with their savings. That's a capital inflows. We get an increase in capital inflows. Well, what do? We take this curve and we shift it to the right. Now, just because you could get a question that's kind of worded this way, like, hey, domestic households start doing less capital outflows. It's not very customary to see it this way, but hey, it could happen. Domestic households start doing less capital outflows. Well, what that means is they're taking less of their savings abroad, keeping more of it at home. So if they're doing less capital outflows, you do that, okay? Pretty straightforward. Next, businesses, okay? Generally, we're not going to shift this curve based on what businesses do, but you could, okay? Technically speaking, you could. If businesses became more confident, so if the question said businesses become more confident in the economy, they want to do more investment projects, you would shift this curve to the right, okay? Technically, the way that would look is it would look just like that, okay? I'm going to erase that, but that's what it would look like if businesses wanted to do more investment based on their confidence in the economy. And of course, if they became less confident, you go that way. The next one is a big one, which is government and their deficits. And I think the way we've drawn this, it makes it really straightforward. Okay, a very straightforward question that we get all the time is, hey, the government deficit increases. What's going to happen to the real interest rate? So government deficit increases. I hope that's straightforward for us. That was the deficit. Now the deficit gets bigger. So there we go. And again, dot. They're going to borrow more now at every real interest rate. Now we add on, just like we had before, that investment demand curve, that business demand for loanable funds. And there we go, our new demand for loanable funds, 0, 1. Again, you don't have to have the vertical, but we can see it very well. And there you go. We see that interest rate going up. Now, on this particular one, I want to show a little bit more, okay? So let me examine this one a little bit closer, okay? So when that deficit got bigger, this is that deficit getting bigger. Even if it doesn't look the same, that distance, if I drew it correctly, should be the exact same as that. I think I probably did not draw it correctly, but technically, if I was a robot, I would have drawn it correctly. That distance should be that distance. That's the increase in borrowing of the government because of their deficit. So I've got a dot there and a dot there. Now, here's the thing. That's not an equilibrium, right? This was the original equilibrium. I hope that makes sense. And look, we can see that new equilibrium, okay? So what is happening? Let's kind of dive into this one, okay? You see that increase in the deficit right there. Government's going to borrow that much more. So this means this demand curve is no longer there. I'm going to leave a little remnant so we can kind of see where it was, but it's no longer there. What does that mean? It means that this interest rate, and you can use an I or an R, actually little r's are often used. We kind of like to use little I, but anyhow, at this interest rate, okay, so what is this right here? The quantity supplied, the quantity demanded. What does that mean? It means now we have a shortage of loanable funds at the original interest rate, right? At the original interest rate, we now have that shortage. So what's going to happen? Well, what happens in markets when we have shortages? The price, which is the interest rate, starts going up. So that interest rate is going to go up. Well, how are we going to react to that interest rate going up? Domestic and foreign households both are going to begin to increase their savings in this domestic loanable funds market. That's what that is right there. That is domestic and foreign households both increasing their savings in the domestic loanable funds market we are examining. Next, you have this happening. Well, what is that? That's businesses borrowing less because the interest rate is going up. So again, that right there is businesses borrowing less. We have a term for that. That's called the crowding out effect, right? That's our crowding out effect right there. All right, now there's one last thing to cover, okay? Some classrooms, okay, do not associate governments and the government deficit. In fact, let me kind of redraw this almost completely, all right? Get rid of that even. So sorry, this takes a little bit of a transition, but there we go, demand for loanable funds. They don't associate the government with the demand for loanable funds. They want that demand for loanable funds to stay very pure, okay? They want it to simply represent businesses, basically business investment. They just want this curve to be the investment demand curve, okay? And everything else that happens in the world, they want to associate with this, okay? So how does that work? Well, here's in a very quick way how we could think about it, all right? So the government deficit increases. Well, with the government deficit, what's happening with the government deficit is it is siphoning away domestic and foreign household savings from businesses. I hope that makes sense, okay? So if the government begins to borrow more, they're going to siphon away the supply of loanable funds from businesses, okay? The demander of loanable funds. So how would we represent that? An increase in the deficit, the siphoning away of domestic and foreign household savings would shift this curve to the left. So supply of loanable funds, 0, 1. And I want you to see something, okay? What we can see, hopefully, when that happens, all right, is this was the interest rate, and then you get that higher interest rate, just like we did the way that we handle it here at Econ Busters by having government here. The big thing is you see that interest rate going up, you get the same answer as far as the interest rate, and you can see that crowding out effect maybe a little bit easier, okay? There it is. That is the crowding out effect. That is businesses borrowing less. Remember, the only thing we're associating with the demand for loanable funds is businesses. That's businesses borrowing less. That's the decrease in business investment. Some people really like to be able to see it so cleanly, so I understand that. Here at Econ Busters, we kind of think, hey, look, governments, you know, they're deficient in funds, and they're being deficient in funds when they run deficits, which they're running all the time. What do? They borrow. They demand loanable funds. And since governments demand loanable funds, we say associate government with the demanders of loanable funds, and just kind of speak about it this way. Businesses and governments compete for loanable funds. That's how we see it here at Econ Busters. So again, we associate government with the demand for loanable funds, but you don't have to, okay? I hope you understood that. If your teacher is having you associate the changes in the government's deficit with this curve, totally fine. You'll still get the main answer we want to get, which is what is going to happen to the interest rate. Anyhow, I told you it'd be soup to nuts, guys. We did everything I think that you need to know just about this market. We'll see you in the next video.